been in private equity now for probably about 20 years, and I've seen the 1980s style reporting all the way through to the current reporting, and it's a different environment that we operate in. But also I think it's very good for the industry. I think transparency is very important.
The regulatory burden over the last, I would say, 18 months has more than doubled, well more than doubled. And the big issue has been there's a whole host of different types of regulation, be it AIFMD, be it EMIR, be it FATCA, that are all coming in at broadly the same time because they were a reaction to the financial crisis.
We have to be careful about what jurisdictions we're marketing in and make sure we are fully aware of the requirements in that particular jurisdiction. And I think that's probably, if anything, more complicated at the moment whilst things are still in a state of flux, and it will become much clearer as time goes by.
Obviously there's a much more heavily regulated environment that we operate in from a fund manager perspective, which is it's going to take a few years for it to bed in before people can navigate the fundraising market efficiently. I think there's still a lot of uncertainty out there for people who are fundraising for the first time in this new environment as to how to go about it, what filings they need to make with local regulators, what licenses they need to get with their own regulator, etc., etc., etc. And I think it's delaying the fundraising process for a number of players.
It's definitely changed. I've been doing the current job for 3 years, and when I started the job, the regulatory content of the role was less than 10%. It's probably now 50%, something like that. And a lot of that is because we've been in the implementation phase where it's needed key judgments and decisions and changing the way we work to deal with it. But it's not going to go back down to below 10%. It's here to stay. And so, regulatory burden, if you want to think of it that way, is changing roles of back office teams across investment managers across the world, but particularly in Europe over the last 12, 18 months.
The regulations have been drafted without any real thought for how it might impact for want of a better term, a non-standard PE firm, someone who does invest in frontier markets where the banks, the custodians, the depositories are frankly just not interested because, again, due to their own compliance requirements, it's too difficult for them to even think about how they might get themselves comfortable. So either they wouldn't do it or it would come at a significant cost.
I think it has fundamentally altered the way that private equity has to go around raising money. I don't think that fundraising will be the same again under the new regime. Will it alter the amount of available capital? I think that is difficult to tell at this precise moment in time. There's been a lot of regulation, all the Basel regulations that affected insurance companies and banks, but the availability of capital in some instances was still there. Some people didn't retrench, some people stayed, and I think ultimately I think new players will come in and some players will back off alternatives. I personally think it's just too early to tell.
The difficulty has been implementing all of these alongside each other, and that has been a significant burden, and it will add cost to the industry.
We've done a combination of things. So we've grown internally, so I've added people in London to help me with the fund administration and that regulatory burden. And also we obviously leverage up on the relationships that we have that advise us on regulatory matters, the legal matters. And we try and use our relationships efficiently to get the best results.
Some of it is systems, so we have implemented a new private equity system that gives us greater control over the data and greater insight into our investments. We've completely reviewed our processes from end to end over the last 18 months, and we have created a regulatory reporting team within 3i. It's about added 10% to the headcount of the finance team within 3i to purely deal with the regulatory reporting. So it's a really big issue, and there's no silver bullet to it. You need to think about all of these things in conjunction, as well as a mindset. So, we spend a lot of time trying to get people aware of the regulation, the things they need to be watching out for, the things they need to be notifying either myself or the compliance team about. And with all of these things, it's an ongoing learning process. So guidance will come out from the FCA or ESMA, and it will change the way that we have to operate. You also mentioned efficiency, and clearly efficiency in a private equity firm, which are usually quite people light, is a really key focus, and that takes a long time to both take on extra burden but then deal with it in an efficient and an effective way. And it's probably taken us the best part of 2 years to operate in the way we do now, which we think is as efficient as we can be, or nearly as efficient as we can be, while dealing with the added complexity of regulatory changes, tax changes, accounting changes, or whatever else comes our way. And that again never changes. We constantly look and we constantly monitor, are we working in the right way? And that's something we engage our team in. We challenge our teams, our sub-finance teams, to think of the ways to do things better, smarter, quicker, use systems more, automate more, and that never ends.
I think they're very sympathetic, and the increased burden on compliance and transparency and reporting and timeliness of that. I think the key thing for an investor is making sure that they get what they need in a timely manner. And that's where you need to make sure that your back office is capable of delivering that.
Where we are impacted, though, obviously is FATCA. We're certainly spending a lot of money at the moment analysing our position, working out what we do need to register, and then what the reporting requirements will be thereafter. And I do envisage some additional complexities there, and with that will come additional costs. And at the moment, with our current fund, we do all of the administration in-house, but I think as we see more and more complexity, we are going to have to look at outsourcing at least some of our reporting.
We're outsourcing a lot of the AIFMD because we don't have the expertise in-house because it's just too new. And you can talk to 2 different advisors and you get 2 different responses, and I think that's where it's creating uncertainty in the sponsors, in the GP's eyes. And so they don't really know which path to go down on, and you just have to trust someone ultimately in order to get your fundraising started. I think a lot of people are still uncertain as to the benefit of it, and at the moment it's still very difficult in some countries because some of their local regulators are still, even they are uncertain on what needs to be done. And so if you're creating uncertainty at the regulator level, then it's very difficult for you as a GP to then go in and market with the confidence that you're not going to breach any of the regulations. So that's ultimately creating a double workload effectively, which is impacting the cost of the business, because we have people who are focusing on AIFMD or regulations when they should actually be focused on delivering investor requests and going about their fundraising process.